mainstream consciousness a little bit? And do you see an environment like that where we finally get a bigger, wider audience in the US, perhaps as a response to another severe round of inflation where that does begin to happen?
Yeah, I think the severe round of inflation is in progress. I don't think it's something you have to wait for. I've talked to about 6 or 8 clients and friends, people who went back to the United States, living in Atlanta, back to the United States, visiting here once in a while and going back to Houston. And they say, Jim, my home insurance has gone from 1,200 to 5,000 in 3 years. And then a California guy said, my home insurance went from 1,500 to 7,000 in the last 3 years. So where's the 6%? Where's the 6% CPI there?
No.
All right, that's triple in 3 years. Okay, I'll get to the crux of your question in a minute here. I just saw a Big Mac price inflation index. And in the last 2 years, it's up 6%, 7%, 8%, 5%, 6.5%, 8%. Okay. I also saw something akin to what was called the Chapman basket price inflation that made the rounds in 2015 or so. Do you remember the Chapman basket, 500 items? He said the price inflation for a 10-year, 12-year period was about 8%, and in the biggest cities, it's 10%. So we have a 22% decline in the economic size. What he's saying is, what does a decline in the economic size mean? That means we have a 20% decline, a 20% depression, a 20% reduction in the economy, a 20% depression. Get that word through into people's heads. We have a depression. We have a minus 5% depression right now. Okay, people are reacting, Chris, to higher prices. People are going to pawn shops and selling items, selling family heirlooms. People are actually selling, up to a couple months ago, they were selling gold and silver to dealers. I heard all last year, Jim, it's amazing. These are dealers in New York, in Atlanta, and Florida, and California, and Texas. Jim, the net is dealers are buying, not selling gold and silver because of the squeeze to households. Okay. Here's some of the consequences. I agree. In a treasury bond situation now, there's no escape. If they lower interest rates, they're going to get a stock rally. Pardon my glasses. Once I hit the age of 70, I had, for reading purposes, I'm no longer a young Turk. If they lower interest rates, we're going to get a stock rally. We're going to get a bond rally. And it won't be really long because there will be a rejection of the treasury bond by foreigners. They will see it as an opportunity to dump more treasuries at a better price than 2 months ago. They're not going to show up for bond auctions. What we will see is a paper explosion, crack up, boom. We'll lower interest rates and we'll get more paper wealth. And foreigners will not want our treasuries and they will dump. If we raise interest rates, we will eliminate the opportunity to escape the depression. Okay, I got news for people. We're using knee-jerk Pavlov moron response. Knee-jerk Pavlov moron response. We think all price inflation is from too much money. This price inflation is from too little supply. The economic lockdown did severe damage to the supply chain. In the year that we had the supply chain interruptions and obstructions and removals, we saw a 5-7% increase in price inflation. That was not from the stimulus, not from the bank COVID stimulus. That went straight to the pocketbooks of the banks to eliminate their bond losses. It did not go to the streets. It went for another boat. It went for another chalet. It went for another Aspen chalet. We've had 3 years now of supply chain interruption and inflation result. The way you solve that is by lowering interest rates to encourage more supply chain participants. If they raise interest rates, you eliminate that. We will never get out of the depression if we raise interest rates. If we raise interest rates, we will only get minimal interest by foreigners to buy treasury bonds. If we raise interest rates, we will add to the 1.2 trillion annualized borrowing costs. By not getting out of the depression and by increasing the borrowing costs, we will probably add another war to keep things stable in a sick way, and we will get a quick march to 40 trillion in the debt. There's no way out, Chris. And foreigners see it. That's why they're trying their best to reduce their treasury bonds and to buy gold. Now, I've got this list, and number one is the treasury bond default.
Although, Jim,
go ahead.
Just real quick before you get into the list, I think what you're saying makes a lot of sense. I'm curious what you think the Fed actually will do. Again, we came into this year with markets pricing in 5 or 6 rate cuts. That's gotten pushed back. We've had periods where there's been speculation about another hike, and would love to know which path you think they ultimately follow, regardless of how unideal both options have become at this point.
That is a really tough question, and I'll do my best. I don't need notes for this. This is messy, very messy. I'll try to keep to the higher level points because everything I say has 5 minutes more in descriptions. This is really messy. Back in November, they realized that the big banks were going under from unrealized 740 billion in asset losses, primarily with treasuries that were down 30, 40%. I heard 45 even. The big banks were insolvent and in trouble. Ooh, this is complex. So the Fed decided, let's trigger a bond rally. Let's talk. And the emphasis was talk about rate cuts. Let's talk about rate cuts and say we need to stimulate the US economy and get out of this difficult situation with a threat of recession, because they don't want to say a worsening depression. So they talked about rate cuts. And in the following 2 months, they did not give a late January rate cut. They did not give a February rate cut. Instead, they said we might not be able to give a rate cut. And that took off the table the rate cuts. They're doing trial balloons on both sides, Chris, to cut and not to cut. Then we had a remarkable situation. In February, they said price inflation is returning. So that was interpreted as removing the rate cuts. Then in March, they said we're going to pay more attention to the labor market than we are price inflation. So that put back on the table rate cuts. Then something I think unprecedented happened. The Japanese cut rates, the Swiss cut rates, Canada talked about cutting rates, and the Americans thought the coast is clear now to cut rates. So we might have a uniform global rate cutting sequence so that the competition of one currency to the other will be eliminated and no one nation will be made vulnerable. But it won't work because the United States stands out with its 34 trillion in debt, growing by 1 trillion every 100 days. There's no way out. I think they're going to do the following. I gotta be clear, because I have a colleague named Euro Raj, and he's a brilliant fellow. I'm going to tell you what I think, and then I'm going to tell you what he thinks, because we don't agree. But that's okay. And I yield to him. I yield to him. Now, there's something really important, a little asterisk here in a footnote. It's called emotional IQ. And a fellow named Gold, having nothing to do with the metal, a Dr. Gold, 20 years ago, talked a lot about emotional IQ. And it is the ability to manage emotions and groups in order to bring about greater output from the group. In other words, forming teams. Forming teams, acting in a cooperative manner, getting a consensus, having a debate, yielding position. That's what I've been doing my entire professional life. I did that in graduate school. I helped a few people get a master's degree. I helped a couple of people in their doctoral program. I went to Digital Equipment Corp, and I became a team player, building statistics skills in my team. I went to Staples and I did the same thing. When I started the newsletter, I developed a colleague group, and I now have built a second colleague group for digital crypto. All right, that's my asterisk side point. I think they're going to do the following. They're going to lower interest rates. It's not going to get much of a bond rally, and it's not going to get much of a stock rally. And they realize we made the wrong move, and we're going to have to raise interest rates because nobody is showing up at our bond auctions, and we have to monetize everything and put the primary bond dealers at risk because they're under contract to buy whatever doesn't get sold at the auctions. So I think they might do a rate cut or two, have a very short-lived bond and stock rally, and realize the damage that they've done to foreign holders who are dumping in a huge way and not showing up at the bond auction. Why should, okay, let's just imagine country X in Europe. The Fed is cutting rates. They've got a bond auction. They're selling a huge amount, a couple $100 billion in bonds. Why should they show up? They're being offered less. The only incentive, Chris, is that they're going to continue with many, many rate cuts, and the bonds will go up in value, and that ain't going to happen. Okay. So therefore, they start raising rates and take away their rate cuts. And we get higher rates than we have compared to where they started. That's what I think is going to happen. But Euroraj has a different theory. He says they're going to do a 25% rate hike, and it won't go well. And then they're going to do a series of rate cuts, 150 basis points, to cause a bond rally. Now, I'm telling you, I just don't see.
I just want to make sure I heard that correct. 150 basis point rate cuts.
Yes.
It would be something.
Okay, Euroraj thinks that we might have a 25 basis rate hike, and it really doesn't do much. Doesn't solve anything. And they resort to try to alleviate the economic depression that they call recession. And they do 150 basis cut. Like it could be three different 50 basis point rate cuts. I tend to think there's no way out of this. They have to raise rates. Otherwise, the pain of monetizing our debt is going to be enormous. Okay, let me give you a sequence. If we have to monetize a lot of our debt because there's not much in the way of foreign, okay, who in his right mind is going to want to show up at an auction if we raise rates? Okay. If we lower rates, who in his right mind would want to show up with lower rates when we know that they won't continue with even lower rates. They're going to see it as a chance with the bond rally to dump their treasuries and not show up at auction. That's what I expect. But let me explain what happens. If no one shows up at the bond auctions and we have a tremendous amount of supply, like 9 trillion maturing this year, Chris, nobody's talking about it. 9 trillion of long dated treasuries are maturing this year and must be refunded. I don't like that word refunded. We must find funding for it. We're going to have to monetize it. And that will bring about price inflation because it's going to enter in the economy. This is no way out. If we lower rates, we're going to get monetary inflation that turns into price inflation. And on top of all that, we've got a conspiracy by BlackRock to cause mayhem, to force people out of their own homes, raising the cost of home insurance. If they can't get home insurance, they lose their entire mortgage contract and turn in the keys and lose their entire equity. If they can't get fire insurance, home hazard insurance, they lose their home and their equity because they can't sell the home. How are they going to sell their homes? Some of them are now underwater. Okay, they're going to be left with, oh my gosh, we got 120,000 in equity now. The home used to be worth 300, and what am I going to do? The banks aren't offering mortgages. Okay, there's going to be a tremendous parade of home titles going to BlackRock, purchased by narco money, and rented out to migrants at $3,000 a month, paid by tax money. Okay, that is a very big, ugly wrinkle coming, Chris. Unbelievable. Unbelievable. There's no way out for what is coming. That's why you're seeing the Fed dithering around. Okay, there was a Johnny Most, Boston Celtic announcer, Johnny Most, fiddle and diddle. Oh, that was it. Fiddle and diddle. He's fiddling and diddling. They're talking about rate cut, and they say we need to delay the rate cut. They say we have to focus on inflation. Then they say, well, we can't focus on inflation. We have to focus on the labor market. Well, the problem is we've got an inflationary depression. So they need to focus on inflation and the bad labor market, which means they need to rate hike and a rate cut. They need a rate hike and a rate cut. Okay, they have no way out. And that's why I focus on my top reasons for the gold market. Gold is the safe haven when there's no way to avoid the debt default, when there's no good monetary policy. You know, we're going to get a surprise in the next couple months. It could be a primary bond dealer going bankrupt, saying, well, we got promises from the Fed to help us, take in funds in order to buy the treasuries, which is all improper, but they only gave us half of what we needed. We have to declare bankruptcy. I'm not talking about a Wall Street bank. I'm talking about a secondary bank acting as a primary bond dealer under contract to buy unsold bond at auction. There's no way out.
Well, there is